Hey guys, Sean here. I wanted to go over a quick rental property analysis for a client that I have that just put this property under contract, and I wanted to share with you the numbers. This particular client loves the Norfolk area for investing in small single-family houses. They already own a property here. They wanted to add to their portfolio. They are active duty military, so they are planning on possibly coming back to the area, which is great. So I wanted to share with you the numbers on this property and show you what we're working with and give you an idea of how to analyze a rental property if you're interested in doing something like that. All right, so let's get into it. So first step, I use Bigger Pockets. This is the website that I use. It is a paid website, but there is some free versions, and you can use this tool a couple times before they're going to ask you to pay for it. So you can get your feet wet and see if you like it or not. So we're going to start a new rental property calculator report. We're going to put in our address. And that is our address. It's going to import some property data, which is great. It pulls some things straight from the internet so we can save some time. So purchase price for this one, they are paying $261,000. This was a foreclosure sale, so it's bank owned. We were really lucky to get $5,000 in closing cost assistance. This is still under contract, so we're working through this right now. Purchase closing costs is, we're going to do $7,500. That's about 3% of the purchase price. They are not rehabbing the property. This house is fully turnkey, which is really awesome. And they did put they are going to put 30% down. And with that closing cost assistance that we got from the bank, we're actually going to buy the rate down, and we were able to buy it down to 6.5 on an out-of-state investment loan, which is really good numbers, to be honest, in today's market. So loan term 30 years. I won't put the points charged here for the buy down because it's being paid for by the seller. All right, gross monthly income is going to be, all right, so this says about $2,175. I know this area, done the research on this. It's about $2,100 is probably a higher end price, $2,000 on the lower end. When I rented this out, I would probably allow pets because it's a end unit townhouse with a pretty large yard. So, and it's fenced in. So I think I would personally allow pets. That would give me a little extra money every month. I'm going to put in $2,100 for that though. And it auto-populates our property taxes, which is great. And then our insurance, I like to switch that to monthly, do $150 for insurance. All right, repairs, maintenance, vacancy, and capital expenditures. Real quick, I want to cover this. I think a lot of people overlook these expenses. So maintenance is your normal leaky faucet, leaky drain, clogged toilet, light fixture stops working, things of that nature. Vacancy, pretty self-explanatory. If they move out and there's a gap in tenants, you have to hold the property. So you do need to have some savings set aside for that. And then capital expenditures are your big ticket items. So a roof, water heater, major appliances, big electrical work, plumbing work that might need to be done. That would be what is considered capital expenditures. Now, this is a 1980s build townhouse. It was recently renovated by the bank when it was foreclosed on. So there's a lot of good stuff in there. It's not all new. So for repairs and maintenance, I'm probably going to go with 4% for that every month. And this is calculated based on the monthly rent. Vacancy, we're in a military town. We have a ton of turnover. There are always people looking for housing here on the rental side. So our vacancy is not nearly as high as a lot of other areas of the country. So for this one, I'm going to go with a solid 3%. I think that's probably even more than I would be setting aside. And then capital expenditures, I'm probably going to go ahead and do another 4% for that. So that should cover those things. Now, something that I like to personally do on my properties, for each individual property, they have their own bank account, checking, and then a savings account for deposits. So in the checking account, as rent gets paid, bills are going out every month, I like to let that account accrue and build up before I touch it. I'd like to see enough money in there to do 2 big CapEx projects. So if I need a new roof and a water heater at the same time, they both go bad on the same day, I've got the funds in the account to cover those before I take any cash flow out. Once I get to that, like for a property like this, maybe $10,000 in that checking account, then I'll start pulling some cash flow out every month, or just leave it in there and be ready to use it on the next investment. So management fee, these guys are out of state, so that's going to be a 10% management fee. That's pretty standard here. They're not going to have to pay electricity, gas, water, sewer. HOA fee is actually $40, so that's a little outdated. That's okay. Not going to pay for garbage every month and all that stuff. So that pretty much sets up. There is some extra stuff. Annual expenses growth. 2% is probably fine. Sales expense, this is 7.5. That seems a little high. I think that could go with maybe 6.5. That's going to be covering their realtor fees and closing costs. And where I did want to see income growth. So this does include an annual income growth of 2%. You'll see that in the evaluation. And the property value growth. So this also includes a 2% property value growth every year. I'm going to bump this up to 3% because I don't see, maybe over the next couple of years will be flat or small 2% growth, but over the long term, this is going to grow a lot more than that every year. So 3%, and then we're going to finish analysis. So we can scroll to the top here. This is what it spits out for us. We have a monthly cash flow of $150. Shows your expenses and income here. And then here there's some sliders here to adjust different items. So if you think, this particular couple may move back to this area, and if they do, they may want to take management over themselves. So they can see, all right, year 1 and 2, we're going to be at 150 cash flow per month. But when we move back and we take over the management, now we're at 363. So you can see, hey, this is what it's going to be in the future. This is what it is now. And you can kind of play with these numbers. And this breaks down your monthly expenses. So it'll show you your variable, fixed expenses, and your total, your mortgage, tax, insurance, and all of that stuff. This is the 50% rule. So this is a quick way to look at a property and say, I think this is going to be a good deal worth my time analyzing, or it's not even close, just move on. And then down here at the bottom, it's going to be your 30-year breakdown. So you've got year 1 through 5, then 10, 15, 20, and 30. And it'll show you what your loan balance is, your cash flow, mortgage payment, profit over the course if you do sell it at any time in the future. And then your annualized return, this is based off of the profits if sold. So that's going to take into account your cash flow that you've collected for that period of time, whether it be, year 5. If you sell in year 5, you're going to make a $40,000 profit and you're going to annualize your return. And that's based on the cash that you have in the deal. So if you, in this case, they have quite a bit of cash, they have $78,000 in the deal being put down at the beginning. So 40,000 profit on top of that is going to be that 7.97 in year 5 annualized return. And that's about it. So if you have any other questions or there was anything in here that I did not cover enough for you, please leave a comment down below, and I hope you enjoyed the video.